Imagine waking up one morning to find your mortgage payment has jumped, your car loan is suddenly more expensive, and your credit card bill has exploded. Businesses stop hiring and the stock market starts to tumble. You haven't done anything wrong, so what's changed? The answer is simple: interest rates. This invisible force quietly controls so much of your financial life, from the cost of borrowing to the value of your investments. Today, we're going to break down what interest rates really are, who controls them, and how they impact your daily life in ways you might not even realize. Let's simplify the concept of interest rates. An interest rate is essentially the cost of borrowing money. For example, if you borrow $1,000 at a 10% interest rate, you'll pay back $1,100. That extra $100 is the price of money. Think of it like paying rent. When you rent a house, you pay rent. When you borrow money, you pay interest. This basic idea is at the heart of nearly every financial transaction, and it's the reason why changes in interest rates ripple through the economy, affecting everything from your personal loans to the broader market. Interest rates are the price you pay to use someone else's money. When rates go up, borrowing becomes more expensive. When rates go down, money becomes cheaper. This single change can impact everything from your monthly bills to your ability to invest and grow wealth. Understanding this fundamental principle helps you see why interest rates are so important and why even small changes can have big effects on your financial life. Interest rates don't just change randomly. They're controlled by central banks, such as the Federal Reserve in the United States, the Bank of England, and the European Central Bank. These institutions have a powerful influence over the economy, using interest rates as a tool to manage inflation and keep things stable. When inflation is high, central banks raise rates to cool things down. When the economy is weak, they lower rates to encourage spending and growth. The main goals of central banks are to control inflation and keep the economy stable. By adjusting interest rates, they can influence how much people borrow and spend. When inflation rises, they increase rates to slow spending. When the economy needs a boost, they lower rates to make borrowing cheaper. This remote control over the economy is one of the most important tools governments have to manage growth and stability. Interest rates act as the government's remote control for the economy. By raising or lowering rates, central banks can influence everything from consumer spending to business investment. This tool is used to keep the economy balanced, preventing runaway inflation or deep recessions. Understanding how this works helps you see why interest rates matter so much to your financial life. Now let's get personal. Interest rates don't just affect big economic numbers, they impact your daily life in very real ways. From your mortgage to your car loan, credit card debt, everyday spending and investments, interest rates quietly shape your financial reality. Let's break down how each area is affected, starting with your home. Consider buying a $300,000 house. At a 3% interest rate, your monthly payment is about $1,265. But if rates rise to 7%, your payment jumps to nearly $2,000, a difference of over $700 every month. The house is the same, your income is the same, but your financial life is completely different. Higher rates mean fewer people can afford homes, and housing demand drops. This is just one example of how interest rates can dramatically change your life. Let's look at your car loan. If you borrow $30,000 at a 4% interest rate, your monthly payment is about $552. But if rates rise to 8%, your payment increases to around $608. Over the life of the loan, you pay thousands more just because interest rates went up. This extra cost can make it harder to afford a new car or keep up with payments, showing how even small changes in rates can have big effects. Credit cards are often the most dangerous form of debt when interest rates rise. If your card has a 20% interest rate and you carry a $5,000 balance, you could be trapped for years. Minimum payments mostly go toward interest, barely reducing the actual debt. This is how people get stuck financially, unable to escape the cycle of high-interest payments. When interest rates rise, loans become more expensive. People spend less and businesses earn less. This slowdown affects hiring, salary growth, and sometimes even leads to layoffs. Yes, interest rates can even impact your job, making it harder to find work or get a raise. The ripple effects of higher rates touch every part of the economy, including your daily life. Interest rates also affect your investments. When rates go up, borrowing becomes expensive and businesses expand less. Profits shrink, and stock markets often fall. Real estate slows down because fewer buyers qualify for loans. These changes can impact your portfolio, making it harder to grow wealth during periods of high interest rates. Let's connect everything. When interest rates are low, borrowing is cheap, people spend more, businesses grow, and jobs increase. But too much spending can cause inflation to rise. When rates are high, borrowing is expensive, spending slows, and inflation decreases. However, growth also slows, and there's a risk of recession. This creates a cycle that repeats over and over, shaping the economy and your financial life. During periods of low interest rates, borrowing is cheap. People are more likely to buy homes, invest, and spend. Businesses grow, jobs increase, and the economy expands. But if spending gets out of control, inflation can rise, prompting central banks to raise rates and cool things down. This balance is crucial for maintaining economic stability. When interest rates are high, borrowing becomes expensive. People spend less, businesses slow down, and inflation decreases. However, growth also slows, and the risk of recession increases. This is the other side of the economic cycle, where central banks try to prevent overheating and keep things balanced. This economic cycle repeats forever. The economy grows too fast, inflation rises, central banks raise rates, the economy slows down, rates are lowered, and growth starts again. Understanding this cycle helps you anticipate changes and make smarter financial decisions, rather than just reacting to the news. Let's look at a simple example. Person A buys a house during a low-interest era at 3%, with a monthly payment of $1,200. They invest extra money and build wealth over time. Person B buys the same house during a high-interest era at 7%, with a monthly payment of $2,000. They have no money left to invest and struggle financially. Same income, different timing. That's the power of interest rates. After 20 years, Person A has built wealth thanks to low interest rates, while Person B struggles financially because of high rates. This example shows how the timing of interest rates can make a huge difference in your financial life, even if your income stays the same. Understanding this can help you plan better for the future. You can't control interest rates, but you can control how you respond. There are several strategies you can use to protect yourself from the negative effects of rising rates. Let's explore these practical steps so you can make smarter financial decisions and safeguard your future. The first step is to avoid high-interest debt, especially credit cards. These debts can quickly become overwhelming when rates rise, trapping you in a cycle of payments that barely reduce the principal. By steering clear of high-interest debt, you protect yourself from financial stress and keep your options open. Whenever possible, lock in low rates with fixed-rate loans. Fixed rates protect you from future increases, ensuring your payments stay manageable even if interest rates rise. This strategy is especially important for mortgages and car loans, where long-term stability can make a big difference. Markets go up and down, but long-term growth matters most. By investing with a long-term perspective, you can ride out the ups and downs caused by changing interest rates. This approach helps you build wealth steadily, without being thrown off course by short-term fluctuations. Building emergency savings is crucial, especially in an unpredictable economy. High interest rates can lead to sudden changes, like job loss or increased expenses. Having a financial cushion helps you weather these storms and stay secure, no matter what happens. Interest rates may seem like a boring economic term, but they control your loans, your job, your investments, and your future. Once you understand how they work, you can stop reacting and start making smarter financial decisions. This knowledge empowers you to take control of your financial destiny. When you understand interest rates, you gain the power to make better choices. Instead of reacting to changes, you can plan ahead, protect yourself, and build wealth over time. This shift in mindset is the key to financial success, no matter what happens in the economy. Interest rates shape your financial future in ways you might not expect. From the cost of your mortgage to the value of your investments, understanding how rates work gives you an edge. By staying informed and making smart decisions, you can secure your financial future and avoid unnecessary risks. Let's revisit how interest rates affect real-life scenarios. Whether you're buying a home, financing a car, or managing credit card debt, the rate you pay determines your monthly costs and long-term outcomes. By paying attention to interest rates, you can make choices that save you money and help you build wealth. Interest rates don't just affect you, they ripple through the entire economy. When rates rise, businesses slow hiring, salaries grow slower, and sometimes layoffs happen. This chain reaction impacts everyone, from workers to investors, making it important to understand how rates influence the bigger picture. When interest rates go up, the stock market often falls. Businesses borrow less, profits shrink, and investors become cautious. This can lead to lower returns and increased volatility, making it harder to grow your investments during high-rate periods. Understanding this helps you manage your portfolio wisely. Higher interest rates mean fewer buyers qualify for loans, slowing down the real estate market. This can lead to lower prices and less activity, affecting homeowners, investors, and anyone looking to buy or sell property. Keeping an eye on rates helps you make better decisions in real estate. Interest rates and inflation are closely connected. When rates are low, spending increases and inflation can rise. When rates are high, spending slows and inflation decreases. Central banks use this relationship to keep the economy balanced, making it important to understand how inflation and rates interact. When interest rates are raised too high, the risk of recession increases. Businesses slow down, jobs are lost, and the economy contracts. This is why central banks carefully manage rates, trying to avoid both runaway inflation and deep recessions. Understanding this risk helps you prepare for economic downturns. The timing of interest rates can make a huge difference in your financial life. Buying a home or investing during low-rate periods can help you build wealth, while high-rate periods can make things harder. Paying attention to timing helps you make smarter choices and avoid unnecessary risks. You can't control interest rates, but you can control your response. By avoiding high-interest debt, locking in low rates, investing for the long term, and building emergency savings, you protect yourself from the negative effects of rising rates. These smart responses help you stay secure and grow wealth. Fixed-rate loans offer stability and protection from rising interest rates. By locking in a low rate, you ensure your payments stay manageable, even if rates go up. This is especially important for mortgages and car loans, where long-term costs can add up quickly. High-interest debt, especially credit cards, can trap you in a cycle of payments. By avoiding these traps, you keep your finances flexible and reduce stress. This strategy is key to staying ahead, no matter how interest rates change. Investing for the long term helps you build wealth, even as interest rates fluctuate. By focusing on steady growth and avoiding short-term panic, you can achieve your financial goals and secure your future. An emergency fund is your safety net during uncertain times. High interest rates can lead to unpredictable changes, making it essential to have savings set aside. This fund helps you stay secure and avoid financial setbacks. Interest rates might seem boring, but they're anything but. They control your loans, your job, your investments, and your future. By understanding how they work, you gain the power to make smarter decisions and take control of your financial destiny. Once you understand interest rates, you stop reacting and start planning. This proactive approach helps you make better choices, avoid unnecessary risks, and build wealth over time. Knowledge is your best defense against financial uncertainty. Understanding interest rates empowers you to make smarter financial decisions. Whether you're choosing a loan, investing, or planning for the future, this knowledge gives you an edge. Take control of your finances and make choices that support your goals. Let's recap. Interest rates are the cost of borrowing money, controlled by central banks to manage inflation and economic stability. They affect everything from your mortgage to your job, investments, and future. By understanding how rates work, you can protect yourself and make smarter choices. Now that you know how interest rates work, it's time to take action. Avoid high-interest debt, lock in low rates, invest for the long term, and build emergency savings. These steps help you stay secure and grow wealth, no matter what happens in the economy. Financial freedom starts with understanding interest rates. By making smart choices and planning ahead, you can achieve your goals and build a secure future. Remember, knowledge is power. Use it to take control of your financial destiny. Interest rates quietly shape your financial life, from the cost of borrowing to the value of your investments. By understanding how they work and taking smart steps to protect yourself, you can build wealth, stay secure, and achieve financial freedom. Stay informed, plan ahead, and make decisions that support your goals. The power of interest rates is real. Use it to your advantage.